You might think choosing between physical gold and a gold ETF is simply a matter of convenience, but that assumption often hides the true cost of your investment. Many investors believe that clicking a button to buy a digital fund is the cheaper way to own the metal, while holding a gold coin is an expensive relic of the past. However, when we look at the actual math over a long period, the convenience of digital ownership starts to look like a very expensive trap. The choice you make today will determine if your wealth grows steadily or if it is slowly eaten away by costs you never see on your monthly statement. The appeal of the gold ETF often starts with the illusion of free trading. In a world of zero commission apps, it feels like entering a position costs nothing at all. This lack of an upfront fee often blinds investors to the recurring drain of annual expense ratios. While you pay nothing to click buy, the fund manager is taking a small percentage of your gold every single year to cover their own operational costs. It is a quiet, continuous leak that never stops as long as you hold the digital shares. Physical gold works in the exact opposite way, which can be a psychological barrier for many. When you buy a gold coin or bar, you pay a one-time premium above the spot price to the dealer. This initial cost is higher than a digital trade, but once the metal is in your hands, the expenses stop completely. There are no management fees and no annual subtractions from your weight. Over a multi-decade holding period, that one-time barrier often proves to be much cheaper than the compounding drain of a digital fund. There is also the hidden problem of tracking error that rarely gets discussed in marketing brochures. Digital funds often fail to perfectly mirror the price of gold because of internal frictions like cash drag and fund rebalancing. This means the price of gold could move up, but your digital shares might lag behind due to the fund's own internal mechanics. You are essentially paying for a proxy that might not behave exactly like the asset it claims to represent. But the hidden costs of digital gold do not stop at management fees and tracking errors. Before we keep going, if you're serious about protecting your savings with real assets, grab your free Gold IRA guide linked below. It explains exactly how to diversify part of your retirement into physical gold safely with no setup fees for up to 10 years. You'll find the link right below this video. Just click it, request your free guide, and see why so many investors are moving away from paper wealth and back to something real, gold. Now let's keep going. When you hold a physical gold bar in your hand, its weight is a mathematical constant. A 10-ounce bar will weigh 10 ounces today, next year, and 50 years from now. It is a finite piece of matter that does not require maintenance to exist. However, when you choose the digital route through an ETF, you are entering a system where your claim on that metal is constantly shrinking through a process known as the expense ratio. Most investors view a small annual fee like 0.40% as a negligible cost of doing business. In reality, this fee acts as a slow bleed on your total ounces. Because the fund must sell off a portion of its gold reserves to pay for its own management and administrative costs, each share you own represents a slightly smaller fraction of an ounce every single day. Over a decade of ownership, you might find that your digital position represents significantly less metal than the physical equivalent you could have tucked away. This erodent effect becomes even more pronounced during a bull market. As the price of gold rises, that fixed percentage fee translates into a higher dollar amount taken from your wealth. While physical storage costs are often flat fees based on space, an ETF fee scales upward with your success. You are essentially paying more to the fund manager simply because the asset became more valuable. This creates a hidden drag on your long-term performance that many paper investors fail to calculate. But the erosion of your ounces is only one part of the equation when you consider how the tax man views these two different paths. When you hold a gold coin in your hand, the legal relationship is simple because there is no one standing between you and the asset. You are the owner in the eyes of the law and the eyes of the world. With a gold ETF, that relationship is replaced by a complex custodial chain composed of multiple institutions. You are not buying gold. You are buying a share in a trust that holds gold. This trust structure introduces layers of intermediaries like the fund sponsor, the trustee, and various sub-custodians who manage the actual vaults. Each layer represents a different company with its own balance sheet and its own legal risks. You do not have direct title to a specific bar of gold in a specific room. Instead, you hold what is known as beneficial interest. This means you have a claim on the assets of the trust, but you are a shareholder rather than a property owner. The system relies heavily on third-party audits to prove the gold exists, but these audits are snapshots in time performed by outside firms. For the digital investor, this creates a reliance on paperwork and corporate transparency that physical owners simply do not have to worry about. A physical investor can open a safe and verify their wealth with a single glance. In a digital fund, you are trusting that the sub-custodian in a different country has correctly reported the serial numbers on the bars. If one link in this chain fails or the legal definitions of ownership change, the paper claim might not behave the way you expect. This vulnerability remains hidden until the moment you need liquidity the most. Now, real quick, make sure to subscribe for more gold videos and hit that notification bell so you never miss a new video. Now, let's keep going. When you buy a gold ETF, you are entering into a complex legal contract with a financial institution. This introduces what professional investors call counterparty risk. This is the danger that the organization on the other side of your investment might fail to fulfill its end of the bargain. In a stable environment, this risk feels theoretical and distant. However, during a systemic shock or a bank holiday, the digital nature of your holding becomes a single point of failure. If your brokerage platform goes offline or a bank freezes its assets, your access to that gold is effectively severed. Physical gold owners operate outside of this fragile network. A gold coin in your hand does not require a functioning stock exchange or a solvent bank to maintain its value. It is one of the few financial assets on Earth that is not someone else's liability. When you own a digital fund, you own a promise of value. When you own the metal, you own the value itself. This distinction is often ignored during bull markets, but it becomes the only thing that matters when the financial plumbing of the world starts to leak. The fine print of many popular gold funds contains a surprising detail called a force majeure clause. This allows the fund to settle your shares in cash rather than the underlying metal during times of extreme market stress. If the price of gold is skyrocketing due to a crisis, the fund could theoretically hand you a check for a fixed amount while keeping the physical bars. This means your protection mechanism could be neutralized exactly when you need it to perform. These structural vulnerabilities are baked into the very convenience that makes digital gold attractive. While most investors assume their paper shares will always track the metal, the legal fine print suggests otherwise. This gap between expectation and reality leads many to question how these two assets are treated when it comes time to pay the government. This brings us to a topic that catches many by surprise: the specific way these assets are taxed. Many investors assume that buying a gold ETF through a standard brokerage account grants them access to the lower tax rates associated with long-term capital gains on stocks. This is a common and expensive misunderstanding. The IRS generally views both physical gold and the vast majority of gold ETFs as collectibles rather than securities. This means if you hold your investment for more than a year, you are not looking at the typical 15 or 20% tax rate. Instead, you could be hit with a maximum rate of 28%. This significant difference can quietly erode the gains you spent years waiting to realize. But the tax burden is not just about the rate itself. It is also about the administrative complexity involved in the reporting process. Certain gold trusts are structured as grantor trusts or even partnerships, which can occasionally result in the dreaded Schedule K-1 tax form. For a retail investor, this adds a layer of accounting fees and paperwork that physical ownership simply avoids. When you sell a physical coin or bar, the reporting is straightforward and entirely within your control. You know exactly what you sold and when the transaction occurred without waiting for a third party to send you complicated documents. Furthermore, physical ownership offers a level of control over the timing of your tax events that digital products cannot always guarantee. With a physical asset, you decide the exact moment to sell a specific piece of your holdings to manage your tax liability. ETF investors, however, are often subject to the internal mechanics of the fund. including rebalancing or administrative sales that might trigger taxable events outside of their control. This flexibility is a major factor in how much of your profit you actually keep. Yet, even if you manage the taxes perfectly, there is another hidden layer of cost that occurs every single time you trade, and it is rarely mentioned in the marketing brochures. When you look at a digital screen, liquidity feels like a simple button press. You click sell, and the trade executes in milliseconds at the current market price. This speed is the biggest selling point for gold ETFs, as it allows you to move in and out of a position almost instantly during regular market hours. For an active trader, this convenience is a powerful tool, but for the long term protector of wealth, this speed comes with a trade off that is often overlooked in the heat of a transaction. Physical gold requires a different kind of patience because you are dealing with a tangible object that must be verified. When you decide to sell a gold bar or a sovereign coin, you are usually looking at an appraisal process rather than an instant execution. You have to find a reputable dealer or a private party, and they must confirm the weight and purity of your metal. This creates a time gap between your decision to sell and the moment you actually have cash in hand, which can be a hurdle if you need funds within minutes. However, the real cost of liquidity is found in the gap between the buying and selling price. In the digital world, this is the bid ask spread, which is often just a few pennies per share in a high volume ETF. On the physical side, you deal with buyback premiums. A dealer will typically buy your gold for a certain percentage below the spot price to cover their own overhead and profit margins. It is a more visible cost than the hidden slippage in a digital trade, but it is one you only pay once at the very end of your holding period. The most critical question regarding liquidity, however, is not about how fast a trade happens during a calm Tuesday afternoon. It is about how the system performs during a genuine crisis. Digital markets rely on a complex web of electricity, internet connectivity, and functioning banking systems to facilitate a sale. If the grid or the exchange faces a significant disruption, that instant execution could vanish when you need it most. Physical gold is one of the few assets that remains liquid even when the lights go out, because its value is recognized globally without needing a computer to prove it. This independent nature of physical gold is what makes it a different animal than a digital certificate. While the ETF offers a quick exit for those watching the charts, physical gold offers a guaranteed exit for those watching the world. But even if you are comfortable with the speed of your chosen method, you must consider where that value actually sits while you are holding it. The safety of your investment depends entirely on the physical environment where it is stored, and this is where the differences between a bank vault and a home safe become a defining part of your strategy. Keeping physical gold secure requires a shift in how you view storage costs, as these expenses are often more visible than the internal fees of an ETF. If you choose the DIY route with a home safe, the sticker price of the safe is just the beginning. Most standard homeowner insurance policies offer very little protection for bullion, meaning you will likely need to pay for a specific insurance rider. This annual premium can sometimes exceed the management fee of a digital fund, yet it provides a level of direct access that no paper contract can match. Professional vaulting offers a different set of trade offs, particularly when you choose between allocated and unallocated storage. Allocated storage means the specific bars you bought are set aside with your name on them, which is the gold standard for security but carries higher monthly fees. Unallocated storage is cheaper because you essentially own a share of a larger pool of gold held by the vault. While this lowers your overhead, it introduces a layer of shared ownership that some physical investors find uncomfortable. Beyond the math of insurance and vault fees, there is the literal cost of secrecy. Maintaining a private holding outside the financial system requires investments in security systems or specialized transport that an ETF investor never has to consider. Many people are willing to pay this premium because they value the fact that their wealth is not a line item on a brokerage statement. However, these tangible costs of protection can eat into your long term returns if you don't plan for them. This brings up a vital question about how you actually prove what you own when the time comes to sell. When you buy a gold ETF, you might imagine that those shares represent a specific pile of bullion waiting for you in a vault. The reality of redeeming those shares for physical metal tells a very different story. For the vast majority of retail investors, the gold behind the ticker symbol stays permanently out of reach. These funds are designed for trading efficiency, not for personal delivery. This means that while you have exposure to the price of gold, you do not necessarily have a direct path to the gold itself. The primary hurdle is the institutional barrier known as the basket minimum. Most major gold ETFs only allow physical redemption in massive blocks, often ranging from 50,000 to 100,000 shares. This requires an investment worth millions of dollars just to reach the front door of the vault. Unless you are an authorized participant or a massive hedge fund, the fund manager will not even consider your request to take delivery. You are effectively locked into a digital representation of a commodity you can never touch. Even if you meet these high minimums, the logistical costs can be staggering. You would be responsible for specialized armored transport, insurance, and fabrication fees to convert large bars into smaller units. These expenses can quickly evaporate any savings you gained by avoiding physical premiums at the start. Furthermore, many fund prospectuses include a cash settlement clause. This allows the fund to simply send you a check for the dollar value of your shares instead of the metal, even if you specifically requested the gold. This creates a surprising level of uncertainty about what happens during a period of extreme market volatility. When you buy a gold ETF through a brokerage account, you are creating a permanent digital footprint that follows you forever. Every share purchased and every cent of profit realized is logged into a centralized database accessible by financial institutions and tax authorities. This digital paper trail is a fundamental feature of the modern banking system, ensuring that your wealth is visible and trackable from the moment of acquisition. For investors who value absolute privacy, this level of transparency can be a significant hidden cost of digital ownership. Physical gold provides a different path because it allows for a level of anonymity that digital assets simply cannot match. While many people believe that every gold transaction is reported to the government, there are specific evergreen guidelines regarding reporting thresholds. In many jurisdictions, buying moderate amounts of bullion or selling certain coins does not trigger an immediate 1099-B filing by the dealer. This means your private holdings can remain exactly that, private, without being flagged in a central ledger the moment a trade is executed. But the real concern for many long-term holders is not just privacy, it is the risk of asset freezing or confiscation. In a digital environment, a government or a legal entity can freeze a brokerage account with a single keystroke, making your gold ETF shares unreachable instantly. Physical gold held in a private vault or a secure home location is significantly harder to locate or seize because it exists outside the electronic grid. This brings us to the question of how these two different forms of ownership behave when the broader financial markets actually start to break down. When you hold a gold ETF, your wealth is geographically tethered to the specific exchange and banking system where those shares are listed. If you need to relocate to another country or access your capital during a regional holiday, you are bound by the operating hours and regulatory hurdles of that specific jurisdiction. The digital representation of your gold cannot cross a border unless the underlying financial plumbing is fully operational and welcoming. Physical gold, however, functions as a universal currency that requires no electronic handshake to prove its value. A gold coin is recognized in a bazaar in Istanbul just as easily as it is in a boardroom in New York without the need for a digital login. This leads many to the survivalist argument, where gold serves as a medium of exchange if the digital infrastructure is compromised. In a scenario where power grids fail or banking networks go offline, an ETF becomes an unreachable line of code on a dark screen. Physical metal remains a tangible tool for trade that does not rely on a functioning internet connection to facilitate a transaction. However, moving a significant amount of wealth in physical form introduces the complex reality of customs and transportation costs. Carrying large quantities of bullion across international borders often requires legal declarations and can incur heavy shipping or insurance fees that digital shares avoid entirely. While the ETF moves at the speed of light across the globe, the physical owner must weigh the benefits of portability against these logistical burdens. These movement costs are just one part of the wider gap between how these assets are valued compared to the actual market price. Selecting between physical bars and digital shares is rarely about which asset is better in a vacuum, and more about the specific job you need that gold to perform. If your objective is to capture a quick price movement over a period of 18 months or less, the exchange traded fund is almost always the superior instrument. The low friction of clicking a button to buy or sell allows you to enter and exit positions without the heavy premiums or shipping delays associated with physical metal. For the short term speculator, the digital convenience outweighs the custodial risks because the time spent exposed to those risks is minimal. However, the logic flips entirely when your planning horizon extends into a decade or more for serious wealth preservation. Over 10 or 20 years, the recurring expense ratios of an ETF act like a slow leak in a tire, gradually draining your total ounces while the metal stays under someone else's control. Physical gold has a higher upfront cost, but once you own it, the ongoing management fees are effectively zero if you secure it yourself. This long term mandate makes physical ownership the logical choice for those who view gold as a legacy asset rather than a trading vehicle. Many seasoned investors bridge this gap by using a core and satellite strategy that utilizes both formats simultaneously. They keep a foundational core of physical bullion in a private vault for absolute security and long term protection against systemic failure. Then, they use a smaller satellite position in gold ETFs to take advantage of market volatility or to rebalance their portfolio quickly. This balanced approach ensures you have the liquidity to act on market news while maintaining the unshakable safety of the real thing. But even with a perfect strategy, your final results will depend on how you navigate the exit when it is finally time to sell. When we look at the total cost of ownership over a decade or more, the math behind gold ETFs begins to shift in a way many investors fail to notice. An expense ratio might look small at first glance, but that recurring fee acts like a slow leak in your boat. Because that fee is deducted from the fund's gold holdings, the amount of metal backing each share quietly shrinks every single year. Physical gold requires a larger upfront cost due to premiums and secure storage fees, but once those hurdles are cleared, the costs largely flatten out. If you plan to hold your position for 20 years, the cumulative fees of a digital fund can eventually surpass the cost of buying and storing a 1 ounce coin. This is why physical metal is often the more economical choice for generational wealth. You are not just paying for a commodity, you are paying for the total absence of a middleman who could potentially fail. This leads us to the true definition of peace of mind in the precious metals market. The ultimate cost of an ETF is the risk that your access to the value could be restricted by a technical glitch or a brokerage freeze. Physical gold carries no such counterparty risk because its value is inherent to the object in your hand. It is a store of value that no third party can cancel or delete. To secure your future, take a moment to audit your current holdings for these hidden fees and systemic vulnerabilities. We'll see you in the next one.